Hello and good day. Steve Charlton here, coming with another dose of financial wisdom. At Wisdom Financial, it is our mission, our purpose to provide you with holistic financial planning to uncover the truth about achieving financial success. So sit back and prepare for today's topic as we'll guide you on your journey to financial freedom. So just a hop, a hike, a skip, and a cutaway. 3 central banks made vastly different calls last week, and here's what it all means for the global economy. In a tale of 3 central banks, the People's Bank of China, the US Federal Reserve, and the European Central Bank, or ECB, all made drastically different interest rate decisions last week. One cutting, one pausing, and one hiking borrowing costs. To recap, new data came out that showed the U.S. inflation had slowed more than expected in May, at its lowest level in more than 2 years. That helped support the case for Fed officials to pause their run on aggressive rate hikes, which is exactly what they did at their meeting on last Wednesday. In contrast to the Fed, the ECB went right ahead with a widely expected rate hike on Thursday and signaled it's not remotely close to thinking about pausing. And then China's central bank, on the other hand, cut 2 key interest rates this week after new data reinforced concerns over a stalling post-COVID recovery in the world's second largest economy. So let's connect the dots here, because what a week has been for central banks. Released just a day before the Fed's announcement, the latest U.S. inflation report showed that overall consumer prices were 4% higher in May compared to the same time last year. A slight step down from the 4.9% jump registered in April, and the lowest increase since March of 2021. Core inflation, which strips out more volatile prices like food and energy, also decelerated slightly last month as well. And on the heels of better than expected data, the Fed decided to pause its rate hiking run, following 10 consecutive increases since March of 2022. But of course, it signaled that it would probably and more likely put its boots back on at some point soon. In fact, most policymakers are predicting that the Fed will need to do at least 2 more quarter-point rate increases this year just to help cool the country's still too hot inflation, a move that would lift its key interest rate to about 5.6%. Most of the central bankers forecast that there will be an interest rate cuts next year, and with the key rate sliding to 4.6% in 2024 and hopefully 3.4% in 2025. But both estimates are significantly above where they were in March, suggesting that the Fed intends to keep monetary tighter longer to try and tame a 41-year high inflation once and for all. The ECB, on the other hand, went ahead with a widely expected quarter-point hike on Thursday, taking its main deposit rate to 3.5%, its highest level since 2001. And unlike its American counterpart, the ECB signaled that it's not even considering pausing, instead dropping to some not-so-subtle hints about another rate hike in July. Finally, and in sharp contrast to both, China's central bank slashed its short-term and medium-term interest rates by 0.1% each to 1.9 and 2.65% respectively, making the country's first rate hike since August of 2022. So here are the key takeaways. Number 1, trying to wake up the economy. The move by China's central bank caught many investors off guard. It reveals that officials are growing more worried about sluggish economic growth and feel the need to intensify their efforts to stimulate the recovery. But while rate cuts may help sentiment in the short term, economists say more needs to be done to lift confidence and get businesses to invest and consumers to spend. And that's because cheaper rates on loans don't amount to much if companies aren't willing to or don't want to borrow in the first place. And that's why many expect their government to eventually announce a broad package of stimulus measures to get demand going again, including a big focus on propping up the country's ailing property sector, which together with related sectors makes around 1/5 of their economy. Number 2, towering interest rates still cast long and dark shadows. Sharply higher rates are putting the screws to risky companies that have loaded up on leveraged loans, which are debt with floating borrowing costs that fluctuate the prevailing interest rates. By the end of May, the U.S. junk loan market had already seen 18 defaults, totaling $21 billion this year. That is more in total number and total value than it saw in 2021 and 2022 combined. and things aren't looking up either, with analysts expecting defaults to rise further as interest rates stay higher for longer and as slowing economic growth further squeezes corporate earnings. Number 3, also something on our radar, is El Nino, the often tumultuous weather phenomenon that results in wetter conditions in the southern part of the U.S. and drier conditions in many parts of the tropics. This guy is set to return for the first part in almost 4 years and could put additional stress on an already fragile world economy, as it could disrupt yield crops, stoke commodity prices, inflation, shrink economic growth, strain power grids, upset supply chains, and much, much more. All in all, coupled with more extreme weather due to rapid climate change, the world could be on the brink of experiencing the most expensive El Nino cycle ever, at least since weather experts started recording such events. As always, folks, we trust that you found this information insightful, as our content does typically cover various aspects of financial planning, investment strategies, and of course, economic and world trends to help keep you informed in advance so that you can prepare properly and do not need to allow disintermediation to negatively impact your portfolio, especially if you are in or are nearing your retirement phase. You have a percentage of your assets that you simply cannot lose. If you have any questions or need guidance on maintaining financial stability, regardless of the economic climate or world climate for that matter, feel free to schedule a 15-minute call with us below. Just click the calendar link and let's get you on the right path. Like and subscribe so we can continue to serve and offer a voice of truth and logic in a very volatile world. Thank you so much for tuning in. Have an incredible rest of your day. God bless.